Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, Jim, here we are, Friday, a Friday that's late in the year. And we're starting to look forward to the festive season.
Well, we just are getting a light dusting of snow as we speak right now. And snow in the Vancouver area. We get lots of snow up on the mountains, but it rarely comes down here to the ocean side.
Yeah.
And there's nothing but panic. People in Vancouver see something. They just call it crystallized dihydrous monoxide, and they consider it deadly and something to be avoided.
Yeah.
And if you see how they drive in it, you'd know why.
Yeah.
Anyway, let's get to listener questions. Our first one comes from Henry Solomon. He says, "Hello, Jim and Bob. Jim's interviews of Bob Hoye are always quite worthwhile listening to. My week is not complete without listening to them. What will probably happen to long bond interest rates, such as the 30-year T-bond, after the contraction hits the New York Financial Center? Will an ETF such as the TLT become an outstanding buy at some point thereafter? Your monitoring of technical indicators should point out the buying opportunities when it occurs."
Yeah, Henry, this is a timely question because of course, the big noise for the last few months has been that 1970s inflation is going to come back, which would take the long bond yield from less than 2% to maybe 15%. So clearly not a place to be. But I don't agree with this very popular theme. I still maintain that it is a huge inflation of financial assets. And from every such one in the past, it's been followed by a serious contraction whereby most asset prices go down. But specifically for the long treasury or the bond future, I think there's another rally in it as some of these hot commodities roll over and the stock market rolls over. So for a nimble trader, there's thing, but I would look at it as a trade. Later on, if we go into a post-bubble contraction, then all the lower grade stuff, junk bond things, would just become, a lot of it, no bid. So there's going to be a lot of money lost there. But at some point, like in 1931, the disaster in low grade bonds was such that amidst that deflation, the yield in long treasuries went up. So long treasury prices got hit. So it's a precarious world out there, but I think there's a long trade for us in the bond future or TLT or those kind of instruments. Yep. Good question.
Our next question comes from our good friend Michael, who's another regular listener and questioner. And Michael writes to us, "Hi, Bob and Jim. Many financial pundits seem to be blaming Jerome Powell for being behind the inflation curve and how quantitative easing must stop now and interest rates must also start rising now, not sometime late next year. They point to 6 to 9% inflation while the Fed maintains real rates below zero. Does this seem crazy? Bob, is Fed Chair Powell waiting until he is reappointed in February next year and wants to avoid a market crash until then? Or is he allowing the institutions time to dump their shares into the hands of retail investors before raising rates? Or is there something else going on here?"
Yeah, Michael, astute question there. First of all, you have to understand that the Fed really isn't in charge. And on massive changes, they're forced by changes in the market, which is forced by changes in the crowd. So, but one of the things we've got to recall that for most of the last decade, the Fed had arbitrarily decided that inflation wasn't high enough. So they had to ease money conditions, not understanding that the main game was inflation and financial assets. So stock and bond prices went to the moon, as they did in 1929. And this, of course, is what the Fed did in the 1920s. They'd seen the horrendous inflation that soared up in 1920. To give you an idea of a number, I mean, the inflation that I experienced in 1980, it got up to something like 15% annualized in the States. In 1920, it got up to 24%. And then it crashed down to minus 16%. So naturally, the Fed was riveted on preventing deflation. So all through the 1920s boom, they were concerned there was not enough inflation, so they kept money conditions easy. And then in the final year of it, all of a sudden speculation takes on new abilities, and you get a wild party, which we have. And every wild financial party has not transitioned into 1970s type inflation. It falls into conditions what I've called a post-bubble contraction, like the early 1930s or 1870s, these times. So the bubbles are remarkably similar as they climax, and remarkably similar as they fall apart. And this is where we've got here now. You've got, well, we'll get into it when we get the headlines, because I picked a couple of headlines that will illustrate this quite adequately. And Michael, thanks for the question, and you have a good new year.
We'll get to some of the headlines Bob has picked out for us today right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. The first headline you picked for us today: the Standard & Poor's rating agency declares Evergrande has defaulted. This must be one of the biggest defaults in history.
Yeah, number-wise, but hey, in each of these bubbles, it's been the biggest one in history, and so the contractions are always the most severe in history. And yeah, it's happening. I mean, this is serious stuff. The major corporations are stopping payment on debt, and that is what S&P calls default. So this is classic, and in previous bubble years, this has gone on with lesser countries, and this one began in March with Argentina and Turkey suddenly declaring that they had a liquidity problem, and then it backed off for a while, and then all summer there's been the story about Evergrande and others in China, and their declines and personal hits are immense. So
now, I don't know what the assets are of Evergrande, but they're hundreds of billions, aren't they? And it's not just real estate. They started building what they hope to be the world's largest stadium, and a bunch of other ventures where they had no experience at all. Yeah,
they just became, got the right side of the party, and it was working. And I'll make some of these notes here, like the chairman of Cynic Holdings saw his 75% stake lose almost all of its value in a single day. And then you got another one here, the wealth of a family behind Kaiser Group slumped by almost 90%. Mind you, if you still got $5 billion left over, it's okay, but when it's 90% less of what it was, it's astounding. So, but the key one here is Yesterday, there's an obscure bond ETF that I follow, and it is sort of an orphan type item. It's EMB is emerging market debt bonds, and this was just kind of junk most anywhere, kind of orphan stuff. So it's a very thin market, and it got whacked very hard yesterday near the opening, and then later on it was about twice that amount, and I thought, what the hell is going on in international low-grade bond markets? And then here's the headline: Turkey halts all stock trading as currency disintegrates. Well, this is a first-class credit crisis. And this is the way they go. They start in, well, I always used to use lesser countries, but then with India and China so big, but then I called them outlying countries. So you've got your very sophisticated financial centers, London and New York. But the rule is that when you have trouble in the outlying provinces, countries, you've got, it eventually hits the financial center. So yesterday I dragged out the quote. Now this is by Cicero, who was a marvelous writer in Rome, and he wrote in 66 BC. He had a very good eye. And here's what he writes, quote, "If some lose their whole fortunes, they will drag many more down with them. Believe me that the whole system of credit and finance, which is carried on here at Rome in the Forum, is inextricably bound up with the revenues of the Asian provinces." That's like Phoenicia, the east end of the Mediterranean Ocean, which was a wonderful venue for trade. I mean, you had thousands of small traders, and each in their own ship, moving goods from one place to the other. But at any rate, Cicero goes on with, if those revenues are destroyed, the ones in the eastern provinces or outlying provinces, our whole system of credit, meaning in Rome, will come down with a crash. Now that's as clear as it can be. And Jim, it shows that human nature and financial markets were the same 2,000 years ago. Outlying regions get a little more aggressive, and with less liquidity get overexposed, and then it starts to crack. And then you have problems in that region, and then eventually it comes and hits Rome. There's another one, Tacitus writes about, I think it was 33 AD, about what a disastrous financial year that was. Now, these two items, like Cicero was writing in 66 BC and Tacitus at 33 AD, they were unrelated. But there are records of fabulous speculation in property markets, in mortgage markets, and a sort of equivalent to an equity in ancient Rome, and then these reaching excesses and then crashing. So when it comes to financial markets, there's nothing new in human behavior. So this makes me very wary and also rather satisfied, because we've been focusing on our writings since March about the threat of these liquidity discoveries in Turkey and Argentina. But then we kept with our theme that the party would likely continue into around September and then start to become vulnerable. And yes, the news dispatches from China about fabulously wealthy people and families losing hugely. I mean, once that's gone, the loss of wealth is immense. And then now you've got the Standard & Poor's rating agency has declared the certain debt in default by Evergrande, And then we roll in and put in Cicero's description of the same thing 2,000 years ago. So, yep, I think the markets, you've always got a favorable season. When it happens, it's called the Santa Claus rally, and it's typical. But we should understand that underlying threats are becoming quite a concern.
Just did a little research on Evergrande. They defaulted on $20 billion in outstanding foreign bonds.
Yeah, I think these are they call them foreign dollar-based bonds. So that means you got to pay to service the bond in U.S. dollars, which is then what pushes the senior currency up in a post-bubble contraction. Is that people have to get their hands on dollars in order to meet their debt obligations in New York. Decades ago, well, more than decades ago, London was the financial center, and it was the same problem then. And then you go all the way back in the 1500s when Antwerp was the financial center, and one of the great traders in history, Thomas Gresham, advised Elizabeth I on financial matters and was very ably helping her. She was a very bright lady, and she had good advisors with her. So he helped the Crown's finance immensely, but every once in a while there'd be a crash, and he would just simply say, no money is available, there's none to be had even on double collateral. So rather than whinging and saying, oh, money has got to come from somewhere, which so many idle intellects go on about in every century with every financial distress, he just described it. Money is unavailable even on double collateral. And this is, I think, what we're going into. And the idea of the Fed being able to keep injecting credit and keep the party going, it's never happened before. So, and Jim, this is very fascinating times.
Yes, we always like to say that, and in fact, may you live in interesting times.
Oh, yes, that's a good one, yeah.
Yeah, it is. Bob, thank you so much for chatting with us.
Yeah, and I hope you and I hope our listeners have a very pleasant and a pleasant Christmas and a happy New Year. And a little eggnog now and then will be quite soothing, I think.
Yeah, I'm more into the nog than the egg. My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, like Henry and Michael did today, you can send them to info@howstreet.com, and we'll ask that question for you. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.